I'm Robin Gagnon.
And I'm Eric Gagnon, and we sell restaurants. We started the nation's largest restaurant brokerage firm, We Sell Restaurants, over a decade ago. You can find us online at WeSellRestaurants.com.
We're on your radio once a week talking with the leading authorities in the restaurant industry about subjects that are trending. You can tweet your own questions on the topic to our Twitter handle, that's Sell Restaurants, or post them to our Facebook page. It's facebook.com/We Sell Restaurants. If we don't get to your question, we'll follow up on our social media channels.
Our goal is to satisfy your appetite for acquisition, feed the need for restaurant reality, and serve up a recipe for business success. If you have any ideas for our show or comments, you can email me. My email address is eric, E-R-I-C, at WeSellRestaurants.com.
This week, we have two highly talented operators who are going to share their stories of growing from a single unit, that's right, one store, to multi-unit operators. For many in the industry, the goal is never just that one single store. You're interested in developing a concept that is scalable beyond one or two doors. You're uncertain about the challenges. Maybe you're interested in advice from others in the industry on how you go into that multi-unit concept. We have two legendary operators who can tell us. First off, we're joined by Aziz Hashim. Aziz is the president and CEO of NRD Holdings, LLC, and CEO and chairman of Impact Investments. Aziz founded NRD in 1996 with one QSR location. He has since grown the company to one of the top 200 franchise operators in the U.S., with several high-profile brands, including Popeyes, Subway, KFC, Taco Bell, and many others. He expanded his portfolio with an investment in Winston Resources, Inc., a public mineral company from Canada, with projects in gold and other natural resources, and in 2013 with Impact Investments for business ventures in Africa. Through expert risk identification and management, unique portfolio management strategies, and superior execution, Aziz has become a leading multi-brand and multinational investor. In 2014, Nation's Restaurant News recognized him as one of the 50 most powerful leaders in the food service industry for setting the standard for multi-unit development. Aziz is often published and quoted in the prestigious franchise industry publications, as well as the Wall Street Journal, the Globe and Mail, Los Angeles Times, and Washington Post. He regularly shares his expertise in franchising as a public speaker and guest lecturer at Emory Law School, Georgia State University, and Harvard Law. Aziz serves on several boards, including the Executive Committee of the International Franchise Association, where he will become the chairman in 2016, the Board of Advisors of the J. Mac Robinson College of Business at Georgia State University, BB&T Bank Regional Advisory Board, and is the chairman of the 2014 Multi-Unit Franchise Conference. He is deeply involved in community service and frequently contributes to the industry, sharing his knowledge and experience at major business conferences. We are so grateful to have you join us today, Aziz.
Thank you very much. Glad to be here.
Good. And we also are joined by Pierre Panos, the founder of several brands, including Fresh to Order, which was named one of Nation's Restaurant News' hot new concept in the food service industry by its editorial staff in 2013, signifying its growth potential. A South African native of Greek descent, entrepreneur and restaurateur, Panos has founded 3 restaurant concepts from scratch and owned 4 different businesses during his career. Panos learned the key to successful restaurant operation is differentiate yourself from the outset by creating something unique. In 1988, at the age of 24, Panos and his brother developed a fast food mobile vending concept, which won the Small Business Development Award for South Africa. After selling the concept for a profit, Panos, a CPA by training, worked as a manager at Cooper's Lybrand, the second largest financial services and audit corporation in the world at the time, and a few years later he developed and operated a full-service casual dining restaurant, Late Night Al's Restaurant, before making the move to America. Shortly after arriving in Atlanta in 1993, Panos became CFO and co-owner of Brookwood Grill Incorporated, overseeing the operation of 4 stores with combined sales exceeding $16 million. He went on to found Stony River Legendary Steaks in 1996, and later Brookstone Management, the parent company of Stony River and Brookwood Grill, which he sold to Nashville, Tennessee-based O'Charley's Incorporated in 2000. In 2000, Panos established QS America LLC, a $59 million company parenting 42 Papa John's franchises, Brookwood Grill, Brookwood Catering, and eventually Fresh to Order, also known as F2O. Fresh to Order came about in 2006 when Panos and his longtime executive chef, Jesse Gideon, partnered to pioneer the innovative fast dining concept in Atlanta, which quickly distanced itself from fast casual concept by providing a finer dining taste profile and an elevated level of service at a fast casual price point. Panos began franchising the highly successful brand in 2010. By 2015, he expects Fresh to Order to have over 50 locations open nationwide and another 50 in various stages of development. In addition to his full plate of business pursuits, no pun intended, Panos remained active in the restaurant industry as well as his community. Panos, Pierre, welcome to the show today.
Thank you.
Wow, I just cannot imagine the caliber of guests that we have today. We're just so thrilled to have both of you share with our audience of would-be restaurateurs and operators how they can actually emerge from that single unit into the kind of success that you two gentlemen have managed to achieve. And Aziz, let's start with you. This is such an amazing story. You moved from a single unit, and I did the math. That was only 18 years ago, one store, to where you are today, one of the top 200 operators in the U.S. Tell me a little bit about that process and your personal journey.
I think it was a journey that began with a love for the business. All through high school and college, I worked in fast food. And when I graduated as an electrical engineer, I quickly realized that that was not my calling. And had a passion to get back into it. So it was a very tough decision for me to give up that career that I worked so hard for in electrical engineering. But I think hindsight tells us that it was the right decision.
Oh, absolutely.
Pierre, how about you? How did you become so involved in the restaurant business from being an accountant? I've worked in an accounting firm, and trust me, they're usually not food service material.
Well, you've worked in an accounting firm, so it should be kind of self-explanatory. You're watching other people and really watching how they make money and trying to find out where you can improve their businesses. And I just got tired of doing that for other people. I wanted to do it for myself. I wanted to make that money for myself. And quite frankly, I fell into the restaurant business literally. My dad owned 3. At one stage, he got to 4 restaurants and some real estate, and which is kind of the combination of what I do today. And at 7 years old, I was standing on a box over the fryer frying, fries in lard in those days. Before the health craze, everyone was frying in pure lard. And so I started at a very young age and just loved the business, and then worked over the years in his different restaurants from fine dining to fast food. I really enjoyed it. But of course, like most dads, the restaurant business wasn't good enough for either of his sons, he felt. And he wanted us to get a real job, doctor, accountant, attorney, something like that. So we ended up going and working, qualifying through Coopers & Lybrand, and both becoming CPAs. And the funny story is, guess who we are both today? Back in the restaurant business. My brother's also in the restaurant business in Atlanta, so it's interesting.
That is great. And Aziz is smiling as well, because it seems as though both of you tried to get away from those roots, but it drew you back in. That's what this business does to all of us, I believe.
Exactly.
Aziz, let me ask you, you have so much experience. Tell us a little bit about when you're analyzing a concept. Do you have some advice for prospects who are just in that process of completing their due diligence? Because you own multiple brands, correct?
Sure, yeah. And I think what I can do is I can share my process, how I look at a brand. I have a 5-step process. The first step in the process is, do I like the product? As funny as that may sound. There are a lot of restaurants out there which sell various types of food, but if I'm not personally comfortable with the food, I would not eat it for any reason. I would not be comfortable with my family dining there. Then it's hard for me to really invest in that brand, because it wouldn't be genuine. It would be just kind of just trying to make it for the money. So do I like the product? Am I comfortable? Would I take my family? Is number one. Number 2 is, do the unit economics work? So again, lots of nice restaurants out there, very good brands, but it's hard to make a buck, because for one reason or another, even it could be that the company does not have the proper structure for food cost control or labor cost, or the brand is not really set up for profit, or it's possible that the ROI, the investment is so high to build that restaurant that you just can't make any money. So the unit economics have to work, because ultimately we want to make money. The third step is, am I comfortable with the brand level management? So in franchising, there's a relationship between a franchisor and franchisees, and it's very important for me to speak to senior management of the brand and make sure that they're aligned with me, and that they have the same type of goals and objectives, etc., and not there just to make a quick buck, as we call in the stock market world, pump and dump, and just get out of there quickly, because I'm usually signing up for a 10 or 20 year commitment. So I want to find out what the brand has in store for me for essentially a generation. The fourth thing is I look at the brand's attitude towards franchisees and franchisee profitability. In the franchising world, the franchisor's income stream comes from top line revenues, and the franchisee's income stream comes from the bottom line. And those are in some ways diametrically opposed because you can raise the top line and really sacrifice the bottom line. So we want to make sure that the franchisor that we're investing in actually has a sensitivity towards franchisee profitability, that understands that their number one customer is not the end user who comes into the retail locations, but their number one customer is me, the franchisee. Their job is to make sure that they support me so that I can generate revenue profitably so that they can grow. So that's number 4. And then the last thing I look at are the documents, the legal and contractual obligations, the federal disclosure document, the franchise agreement that I'm expected to sign to make sure that I can live with those terms. And that's also an area where, there are some very complicated issues come up. And we want to make sure that the franchise agreement is something that for 20 years, we're not going to have a problem with elements of the franchise agreement. It's got enough flexibility in there to protect me and my equity in the business, etc. So basically, those are the 5 big points. Now, within those are lots of smaller details and nuances, and you need the right team of advisors to help you navigate through. But if a brand passes those 5 initial tests, I can go further with that brand.
Very good advice. I don't think I could have put it better than that. That's a very good highlight of it. Pierre, how about you? You've launched multiple restaurant concepts, including a hot dog stand in South Africa, Stony River, Brookwood Grill, and Fresh to Order. At what point do you know when it's time to grow from one unit and say, okay, we got to do more of this?
Well, it's organic. You never really know. You just take the next step. And what I've done always in my business is, if it's not profitable, very simply you don't grow it. A lot of people grow for growth's sake. And, we have over 60 restaurants now, and every one of them is profitable. And we continue to grow those because they're profitable. So as an example, during the downturn in 2009, 8 to 9, and early 10, we basically spent a lot of time re-engineering and optimizing the unit level economics for our Fresh to Order brand, because I knew that I wanted to franchise that plus do company growth. So we spent a lot of time optimizing that brand. And going back to what Aziz said, if the brand is not something which cannot make money, we're not going to grow it. So we're a franchisee of Papa John's. When I looked at that brand many years ago, probably 13 years ago right now, they were the highest ROI, ROE, and sales to investment ratio in the business, bar none. We looked at hundreds of brands, and they were number one. That's why I got involved. I just sold Stony River, wanted to get involved in something which I could grow and scale, plus something that was a national brand that made great money. So it was a great placement of our money. Fresh to Order, on the other hand, is something that I started up from scratch. I wanted to create something in what I call the fast fine space, not fast casual, a couple of levels above fast casual. So I wanted to create something, and of course, you start off with one store, you optimize that store, you make sure the unit economics work, you make sure that the guest acceptance of that brand and of the positioning of that brand work, and only once you see that it is something which resonates with your guests, do you take it to the next step. It's one step in front of the next. Then you do your next store, and then you go from there. So with Papa John's, I bought a batch and then grew from there. It was more like an annuitized income, just wanting to place equity, let it grow and let it multiply, use some leverage, put equity, and you get a great IRR by doing that. However, with Fresh to Order, it was literally one step in front of the other. So how do you go from one to multiple? Deliberately, and exactly that, one at a time. And you got to know when is the next step. When do you take the next step? And if it's not profitable, don't do it. There are a lot of concepts out there in Atlanta alone that explode over 2-3 years and then explode the other way, implode, and go to almost 0, 1 or 2 units. And Atlanta is a hotbed of concept development and also of concept cemeteries. There's a lot of concepts that die here because they do grow too fast. So it's not about trying to start a brand, grow extremely quickly, and trying to sell it, because a buyer is smart enough to know that you're just scaling it to sell. It doesn't make money. We're not in a .com industry. You can't sell something which doesn't make money. You have to have operating income, and you have to show deliberate growth, and you have to show that it works. So that's the essential part of it. Don't try and scale it before it actually works. When it works, you'll know to put one step in front of the other, And then you also got to know when to pull out of it and pull back and work on the business and not in the business. If you continue to try work in the business and run it on a day-to-day basis, you'll never scale it, you'll never grow it. And that is a very fine point to realize when you need to pull back. And most operators look and say, I can't pull back because I can't layer in that extra $40,000, $50,000 that it's going to cost me to bring in a GM so that I can work on the business and develop to the next level. You have to take that step at some point. But if it's not profitable, obviously you don't do it, you optimize it. But once it becomes profitable, you got to step back, work on the next unit, bring in a good GM, and go from there. And a lot of operators do not get past that step. I always say one restaurant is very difficult to run. 2 restaurants is even more difficult. It's like running 10. Once you get past 2 to 3, you should be able to run 7, 8, 9 restaurants. You layer in the levels of support to get there. So it's a process like anything else.
I really appreciate that both of you have such candor about the fundamental financials associated with the business, because this is an industry where people are very, very passionate, and they get emotional and they jump in, but then they forget those baseline fundamentals, the actual economics. And Aziz, just to follow up on some of what you've already said, tell us a little bit, if you would, our audience, some of the greatest lessons you've learned while expanding your portfolio.
I think clearly the first lesson is hiring the best people. Any business, whether it's a restaurant business or any type of organization at all, is essentially, any company is just people. And if you don't have the right people, you cannot expect the right results. And that's an area where I think that a lot of us have learned, through the school of hard knocks, because when you're growing and you're starting, you can't afford the top people. So you make compromises, and later on you pay the price for those compromises. And so to be able to recognize and have an eye for talent is one of the most important things an entrepreneur can first develop within themselves, because that is the key to success, I think, over the long run. Secondly, definitely, picking the right brands. It's a big investment in the franchising or any business to put your money in. It's a commitment. It's not something that you can, go back to Walmart and return it tomorrow. I mean, once you're in, you're in,
That's right.
So you have to pick wisely. You have to have a really strong, what I call dream team of advisors around you. A good lawyer, a good accountant, a good risk management person, someone who can tell you about your insurance needs and the risks that you face, a good banker, etc., a mentor or two if you can find that, to have people that you can bounce ideas. Now, this is not to be confused with paralysis through analysis, because as an entrepreneur, you must take risk. So at some point, you've got to pull the trigger, but you do that as intelligently as possible. You manage the risks as much as you can. And then, as Pierre said, and a lot of us have discovered, is don't be afraid to sell. If something doesn't work and you've tried your best, it doesn't work. And then you have to just, pull out and take your lumps and take the hit and move on to something else. You shouldn't be afraid to fail, and you shouldn't try to put good money after bad. And a lot of people make that mistake, is they get so emotionally attached to their business that they will not step aside or, fold it, because they feel that it's a personal, failure on their part. Business is about risk. There will be failures. No one I know that has achieved any modicum of success has not had failures. That just does not happen. So be prepared for that. Of course, you try to minimize failures in your life and in your career, but when they do occur, you have to brush those off, and you've got to quickly pull up, the tent and go home and then try again the next day with something else. So those, I think, are the major lessons that I've learned over the last few years.
Aziz, I heard something really interesting the other day, and I passed it on to my son, who's 18 years old and in college, and we're talking about business and entrepreneurial pursuits. And I heard something that says, for young kids these days getting out into the world, they need to fail quickly and cheaply, because typically they'll do it 3, 4, 5 times before they actually hit on something. And I thought that's so interesting. Fail quickly. Why fail quickly? Because if you fail quickly, you can go on to the next thing. Don't be scared to fail. It's okay. Go out there and try it. The time to fail is when you're younger, when you don't have a lot of commitments. And then, and quickly, of course, relates to cheaply. If you go too long and you fail slowly, it's always expensive, because you're throwing good money off the bat. So essential for kids these days and young people coming up, fail quickly, fail cheaply, and move on to the next. And yes, don't be embarrassed. Some businesses fail. Fail quickly, cheaply, move on, cut your losses, and get onto the thing that works. And that doesn't mean that you can't work hard and put your head down and keep going at something, but if it's not working, you got to know when to move on. And I thought that was an interesting analogy for people coming up in the business today, in any business, but specifically our business.
I think, Eric and I guest lecture on occasion, and that's something that we have always shared with the teams that we're talking to, the young students, right, Eric?
Yeah, we tell them, you have the ability to fail. You don't need $300,000 a year to feed your family. You're young. You can learn from your mistakes now and be very successful in the long run. And we say that. And you guys' words are so in line with what we do as restaurant brokers that if you ever want to change a career, you are more welcome to work at We Sell Restaurants, because this is what we talk to all our buyers and sellers, especially sellers. Hey, it's not working. There's no shame in it. Don't get attached to it. Let's move on. Get you some capital back. Move on to your next project. I have clients that say, hey, I've won 2 times. I failed 27 times before the 2 victories. And that's why I won, because I failed 27 times. So very, very true words. Pierre, when you consider, growing, you have grown, F2O, of course, you started franchising in 2010, so it was really tough economic times, and you still, were able to grow to 50 units. What do you consider when you grow the number of units despite the difficult economic times that we had? What are you considering then?
Well, I think sometimes the best time to grow is when there are difficult times. If you can imagine and succeed in growing during difficult times, when the real estate is relatively inexpensive and landlords really want you, you'll absolutely explode when the times are good. And that's what's happened. We have currently 35 units under development, and we are growing our brand, the Fresh to Order brand. So we just put our heads down and we got our team around. We do have, as Aziz said, we have a dream team. We have great people in our company. A lot of them have been with me a long time, some 20 years, a lot of them actually 18 years. And so you get a team together that enables you to not only ideate but grow a concept, and then you continue working and tweaking it. You never finish. We work very hard constantly to differentiate our concept so that as people catch up in what I call this fast, fine space, we'll always be a step or 2 ahead of them. We never rest on our laurels. We're always moving the bar up. So we regrouped a little bit in 2008 and 9, but we definitely grew somewhat, and then we started growing again in 10 and 11. If you can show strong numbers and growth during a downtime, it just makes it that much easier when times are good like they are today.
Okay, Pierre, I want you to hold that thought, because I think everyone is just having a great time listening in today as we are speaking with Aziz Hashim and Pierre Panos, both just megastars in the restaurant industry in terms of multiple units. You're on the air with Eric and Robin Gagnon. We're the Restaurant Brokers. Remember, we're sponsored in part by Today's Restaurant, the food service industry newspaper. We will be back on the air in just a moment, where we satisfy your appetite for acquisition, feed the need for restaurant reality, and serve up a recipe for business success.